Hi, and welcome to the third edition of our Digital Disruption series. Continuing with our BFSI theme, we are going to talk about life and annuity insurance, simply put, life insurance. So, life insurance largely is a product push model wherein insurance players design a product and have multiple outreach systems which are heavily analog in nature. There are multiple distribution models, be it B2B, business to business, B2B2C, B2I2C, which is I being the intermediary to reach the customer, and kind of a pushy salesman sells a cover to you. While this has been predominantly in vogue, there has been many life insurance companies which have opened up D2C or direct to customer channels. However, this D2C business currently is fairly minuscule for the large insurance players. Having said so, and credit be due to our insurance companies, there's been a lot of automation efforts that has been going on over years in terms of Salesforce automations, where salespeople have been given tablets to engage with their customers. There's been product visualization tools, product recommendation engines, differential customer journeys, and so on and so forth. There have been multiple instances where the back end or the underwriting process has also been technologically upgraded in terms of its automation processes. Having said so, there is a very few insurance company who have embraced digital in its totality in terms of reconfiguring its core, changing the product push model to a customer centric model, and also working at creating new revenue models in the adjacencies or peripheries. Now, when I look at the insurance market overall, there has been lesser number of disruptors compared to property and casualty. So what I'm going to do in the video is I'm going to look at the global insurance market, kind of curate content around a few important business archetypes. So I've abstracted few important business models which are available in online direct insurance, and therefore also look at a leading insurance company in India and how it is transforming itself. And finally, like in other videos, come up to the so what question to say what are the important features or what are the important imperatives that current insurance carriers need to consider. So stay tuned to the end of the video. If you like the content, share, comment as you deem fit. And with that, we start with the conversation. The first is direct. First, as we talked about the digital first business model archetypes, three archetypes: direct to customer, which is classical. It's quite a horizontal, and there are a lot of companies under it. There are some which we found out was sharply product differentiated, and finally there was this niche companies. So I'm going to start with the D2C model with a company called Ladder Life. It's a D2C term insurance online player, purely digital native. They do not charge commissions or employ salespeople. They allow users to get a quote and apply for insurance life cover online or via mobile. At Ladder, every customer is underwritten individually, which means it's impossible to predict whether a customer will be asked to comply with medical tests. In the event it's required, a traveling salesman will come to home or to your workplace, measure BMI, take blood pressure, and collect samples. The USP is it targets young customers who need insurance but find the current system cumbersome. Next up, it's an online distribution company called Besto, backed by an insurance carrier, North American Life and Health. It distributes term insurance plans. While for many insurance companies, health checks could be mandatory, but in the case of Besto, no medical checks are required. It uses predictive models based on inputs given by the customer to do its risk assessment and adjusts the premium accordingly. Moving on, the second category or the second business model archetype is sharp product differentiated. These companies differentiate on uniqueness of their products and offerings in the marketplace by creating entirely new markets for themselves. Now, Singapore Life is one such company which is fully licensed mobile first life insurance company approved by the Monetary Authority of Singapore. One of its distinct features is that it's a Singlife account. The Singlife account is an insurance savings plan that earns 1.5% annualized returns with no lock-in period. The account gives insurance protection against unfortunately life insurance coverage in the event of death up to 105% of the account value, which is paid to your near and dear ones. Retrenchment cover, payout of $10,000 over 3 months. And then for Singlife account is not a bank account, it's an insurance savings plan with its capital guaranteed by the Singapore Deposit Insurance Corporation. Next up is the Skull, or a company called Dead Happy. while it's morbid, but it's a very unique proposition. Everyone knows that life insurance only pays out when you die, but few providers overtly draw attention to death. Death Happy is an intermediary which designs life insurance products itself, but ultimately the cover is underwritten by General Reinsurance. It's a pay as you go provider, which means the premiums are priced yearly on your current level of risk and not a prediction about the risk of dying over a 30-year period, for example. The policies are for 10 years, which can be changed at any time. Any increase in duration would require a customer to answer underwriting questions all over again. That means once 10 years are up and you went for another 10 years, your premiums would raise as you grow older, but could also potentially decline if you gave up smoking or embraced a healthier lifestyle. This is a very interesting proposition where the adjustment of the premium is what makes it unique. Some companies have differentiated themselves by creating absolutely niche and focused markets. Fabric Insurance is one of them. Fabric is a one stop shop for new parents to organize their families' financial lives. Fabric allows new parents a free will and purchase affordable insurance without meeting an insurance agent or undergoing a health examination. The uniqueness of Fabric is filling the void that a new parent faces after childbirth of not having a well thought out roadmap and protecting the family's future. So the big thing about Fabric is creating a roadmap for the child and protecting the child's future. Now, these are few examples of a set of 50 companies who are in the D2C business. However, I think because of regulatory reasons, D2C direct full stack insurance models are not available in India. Having said so, it's also imperative to understand how the classical insurance players, the big ones like the HDFC Lives, the SBI Lives, the ICICI Prudentials, are transforming themselves, which in itself is quite an amazing story. In the next section, I will demonstrate from a public document of HDFC Life, a company I greatly admire, on their vision of, creating a very differential life insurance company. And here goes. Let me just give me a second as I change the slide. Right. Now, you will see on the left hand side is the product factory or the product push model that I talked about, which has agency banker group, banker being the bank led insurance model, and how they are converting to the insurance of the future, insurer of the future, which is basically a technology driven process where the customer is in the center. Multiple digital channels, HDFC Online or the aggregator Policy Bazaar or other aggregators in place with digital platforms at the left hand side. Now, when you're keeping the customer in the center, your product development ceases from being a product out model to a customer centric model, which is then distributed through traditional channels or through digital channels or through an ecosystem play, which is retailers, telcos, internet companies, and what have you. Now, HDFC Life's model is probably the model that Indian insurance companies will adopt in the future. Now, this transformation is fairly complex, and what companies would struggle is to convert piecemeal automation into a holistic and relevant digital transformation which is scalable, which is attractive to the customer. One of the things that I have figured out in my consulting with some with some analog insurance companies is that since they are not digitally native, their understanding of the dynamics of the net of the World Wide Web is fairly rudimentary, which makes it a bit of a challenge to understand how to kind of enhance, how to attract customers from the net. As a result of which, because of a certain use of keywords, they land up spending a lot of money and making the channel unviable. And I have had discussions with people saying that this channel is extremely expensive, however, and therefore it's a chicken and egg kind of a solution. So mastery of the digital channel in terms of developing of the competencies is a critical endeavor of incumbent life insurance players to be able to win the battle of the web. Otherwise, at some point in time, some kind of an OTT player will take the market and cannibalize the product story of existing life insurance players. Now let's look at what is going to happen next in terms of a few points that I thought I would abstract from my experience of working with the industry. Regulation permitting, OTT models will come up in life insurance space like Toffee Insurance. So you will have micro insurance, different kind of event insurance, which has come up, and it will be backed by bigger insurance players or partnered by bigger insurance players, similar to Toffee Insurance in the PLC space. We talked about product push, and the product push model over time will die. However big the company is today, the channels will be cannibalized, and personalization in the existing channels will also become important. Now, the third point I just spoke about, the D2C model will have to grow as the country's demographics change, and we have a digitally native generation coming up. Traditional insurers will need to ramp up their digital marketing capabilities, a very significant challenge for them. Now, the fourth one is where annuity manufacturers will need to engage with customers to help them live a much better life. Life insurance companies will provide personalized reminders, notifications around disease management, and use of wearables will make it easier to shape the customer's health. Fifth point, this I have had debate with many of my colleagues in life insurance, and I am a great believer that the ecosystem models will come in play in the next 4 or 5 years, 3 to 5 years, and there'll be two archetypes: an ecosystem orchestrator, where a life insurance company will be the center point of creating partnerships to give a consumer a total wealth solution. This would work well for standalone insurance players. However, for major multi-business line players or bigger financial houses where life insurance is one of their businesses, they will be ecosystem participants. So typically the ecosystem orchestrator in that case would be the banks, and where insurance products will be integrated with a large wealth management space. So for instance, HDFC Life will be an ecosystem participant, which of an ecosystem which will be orchestrated by HDFC Life, which will provide end-to-end wealth management solutions, right? The sixth one is again kind of a repetition, if you may. You have to relook the distribution model, and the rise of fee digital, which is a combination of physical and digital models of distribution, will come in place. Seventh point, like fabric insurance, niche insurance models will emerge, and smaller life insurance companies will seek uniqueness. So if you are a 25th or a 26th entrant in the life insurance space in India, you will never be able to compete with the top five because of this assets, which are the scale assets already in place and their incumbencies. So the ability to determine niche investments or niche positions in the entire life insurance landscape will be very important, and over periods of time, for survival, smaller companies will find niche positioning, and that would obviously open up a new space, a new product category, and new models to service customers. So kind of coming to a conclusion, the battle in the life insurance space is different than what we saw in the property and casualty space. Here, the battle is not about incumbency between the digital incumbents and the existing player. Here is about how the incumbent players use technologies to create gestaltic or holistic distribution models, holistic digital models, as against doing piecemeal automation and trying to survive in this landscape. There will obviously be smaller players, people who are ranked 15th downwards. It is impossible to compete on scale because scale economics will not work for you. So the ability of finding niche market positions and creating value in the adjacencies is going to be very important. And also in those cases, ecosystem play, banca play are going to be equally relevant. With that, I conclude this discussion, and from BFSI, we're probably going to move into other sectors in our next series of videos. Hope you had a good time and this was useful. Again, this is a very limited view of the life insurance sector. It is to set you thinking on what is going to happen in the space. So do continue your reading in the sector and not consider this as the only source of information. Thank you for your time.